All right, hello everyone, and welcome to our latest ALTA Insights webinar. I am Jeremy Yohe, Alta's Vice President of Communications, and thank you for joining us today as we discuss the top topics in commercial real estate. This is definitely a hot issue as we've had more than 700 people register for today's presentation. So thank you again for taking some time today and joining us. Our speakers today are going to dig into some various issues, foreign ownership of U.S. real estate, alternative lending scenarios, FinCEN's upcoming AML rule that goes into effect in December, wire fraud and cyber incidents in the commercial space, and distressed property transactions. Before getting into the presentation, I've got a few housekeeping items to go over. You can download a copy of today's presentation from the handout section in the Go to Webinar window pane. Today's webinar is being recorded. You'll get an email with a link to the recording tomorrow, and you can always access all of Alta's webinar recordings at alta.org/webinars. Anytime you have a question, submit them in the questions box. We'll hold some time at the end for Q&A. And I think what a lot of you are also here for is CECLE. We are offering credit in many states. Credit's only available for those attending the live presentation, and our platform tracks attendance. To meet state compliance, there'll be a couple of poll questions during the webinar, so make sure you're paying attention. And as Hall & Oates saying, private eyes are watching you. Haha. Toward the end of the presentation, I'll post a link in the chat box so you can get the information needed for us to report your credit. I'll also post some instructions on how to do this. Don't worry if you don't get it. You can shoot me an email. I'll give you the information afterward as well. I do need to thank SoftPro for sponsoring today's webinar. And before introducing today's speakers, here is a short message from SoftPro.
The title industry moves fast. Shouldn't your title production software keep up? SoftPro Hosted is a cloud-based title, closing, and escrow solution designed to make your life easier, your workflow smoother, and your business more efficient with reduced IT costs, remote work capabilities, process automation, 90+ vendor integrations, award-winning customer support, and over 40 years of industry expertise. Learn more about why SoftPro Hosted is the smart choice for title professionals looking to take their operations to the next level. Visit softprocorp.com/choose-hosted.
All right. Thank you, SoftPro. Now let me move a few things on my screen here, make sure we're having a PowerPoint showing again. There we go. All right. Thank you for all that. Let me introduce today's speakers. Joining us today, we have Nancy Landmark. Unfortunately, Nancy's webcam is not working, so trust me, she is here with us. Nancy is
going to make a dramatic entrance. I think it's going to happen midway through this thing.
She will.
We're trying. We're trying.
Nancy is Deputy Chief Underwriting Counsel of National Commercial Services for Stewart Title Guarantee. Nancy works directly with customers and their counsel to resolve complex title issues so they can close their transactions in a timely manner. Also joining us today is Len Prescott. Len is Senior Division Counsel and Director of Underwriting for First American's Agency Division. In addition to his leadership and management responsibilities, Len remains an active transactional underwriter and has underwritten some of the most complex and largest transactions in the title industry. You've got two very experienced people in this space, so I'm going to give the keys over to them and be quiet. Nancy and Len, the stage is yours.
Thank you so much. Let me just say on behalf of Nancy and myself, we are so happy to be here. Nancy's a good friend of mine. I always enjoy our conversations. We've presented together as co-presenters numerous times over the years, and we thank all of you for being here with us. We love being underwriters. We've talked about how it's the greatest job in the world. We love our industry. And, you know, I love how we're starting to understand and talk about title insurance differently and talk about it as a service. And that's really going to be thematic throughout everything we talk about in this presentation, because, you know, the elevator speech we used to give about what title insurance was and that it was an indemnity and duty to defend didn't resonate as much as the services that each of you and all of us provide, you know, under search and exam and clearance and closing and post-closing. And the indemnity and the duty to defend is the backstop if we got something wrong in all those different services that we provide. So it is something that I'm very passionate about and very grateful to be part of this industry. And despite all the changes, all the things that are challenges to us, I think all of us should be as proud and as engaged within our industry today as ever before. Nancy, did I represent you well?
I think you covered it great, Len. And you know, I think as our world changes faster and faster, our ability to remain nimble in our space and really meet our clients where they are is key to our ongoing success as an industry.
100%. You know, we also know there's pretty much got to be, with the numbers that we've got, a broad audience experience as far as commercial real estate transactions. So our goal together is to provide information that's going to be interesting and helpful to the most experienced commercial practitioners, but we also want to make this interesting and approachable to the less experienced folks, or that folks that are interested in getting into that commercial world. So we've got a lot to talk about. Nancy and I have always been able to fill up a full hour with no problem, and we do want to see if we can answer questions. If we don't get to the questions at the end, still ask them away, and we'll try to get your answers to any questions that you may have offline as well. So the first one we're talking about is foreign ownership of U.S. real estate. And of course, we all know that there's many state prohibitions that are going into effect. We'll talk about that. But a lot of people think, oh, that's just residential. That's going to be something rather than commercial. Not at all so. So one of the first things you've got to all be aware of, both residential and commercial, is CFIUS. I see on the screen making a joke. Is that a disease? No, it's not a disease. It's the Committee of Foreign Investment in the United States. Had you heard about this? It's actually been around since the 1950s, when there was a defense bill that established an interagency committee. They're authorized to review different transactions involving foreign investment in the United States. And since 2020, they have been focused on certain real estate transactions by foreign persons. The CFIUS authority, the act, allows the president to suspend or prohibit different transactions. And we've got at least one, even though it has really gone to real estate since 2020. I'll talk about one example where we've already got a commercial transaction where President Biden has ordered that the foreign entity that purchased land in Wyoming has to divest of that property. It's also important for us to talk about CFIUS today, because CFIUS has been expanding since 2020. And in fact, there's a brand new effective rule that just went into effect on December 1st of this past year. So in that, they expanded the different geographic ranges that real estate transactions for foreign persons are going to be affected. They added 60 military bases, different sensitive government installations. It covers 30 states. We decided not to provide for you the CFIUS order, mostly because it's subject to change. And so rather than providing it to you and having you want to download it or keep it on your hard drive, the best thing for you to do is to make sure you're consulting the current version of the list of sensitive areas, which will be in the appendix. The easiest way to do that, you can search by CFIUS, but if you want the specific reference, it's 31 CFR Part 802. And you're going to be looking at the appendix Part A. It's likely to expand. Go ahead.
Len, I was going to say, you mentioned the bases and certain key infrastructure issues that we need to deal with, but it doesn't apply, CFIUS doesn't apply just to those bases or those structures. It's broader than that, right?
100%. In fact, when we talk about these different bases or the facilities that we're concerned about, and again, we're talking about national security. So the CFIUS is tasked with looking at foreign person transactions and saying, with this real estate purchase, with the occupation of that land, would it be a danger where they'd have the ability to collect intelligence or monitor activities? You think about facilities that are going to expose national security activities to the risk of foreign surveillance. So there's different classes of risk. And so within the rule, certain of these government facilities and bases are going to have a 100-mile radius. There's 19 military installations that 100-mile radius around that will be prohibited and part of what CFIUS is looking at. And by the way, someone that's going to purchase can voluntarily apply and disclose, provide notice to CFIUS and get an approval that, okay, thank you, we're going to let you get this. So I think I'm talking too much when I say a prohibited transaction. I think we should talk about CFIUS more in terms of the monitoring and the potential for them to rescind an action. Other real estate transactions might be only a mile, and you're really going to have to look at the different sites in particular.
Len, the president could say at the recommendation of CFIUS, you can't close that deal. But because of the length of time it takes, more often than not, it's an after the fact issue, right?
That's right. And we have one case study. It's called Mine1. Mine1 was a Chinese cryptocurrency company, and they bought property back in June of 2022. They made improvements to the property to use it for the cryptocurrency mining operations. The problem was this is 1 mile from the Warren Air Force Base in Cheyenne, which is a strategic missile base and very important. So CFIUS reviewed and investigated that transaction. And by the way, that one was not one that Mine1 had filed for approval of the transaction in advance. So that's a good example of where, whether they file or not, CFIUS is going to investigate and determine whether a transaction is something that they are concerned about. They identified this Bitcoin mining operation as one that could allow for significant national security concerns. And so May of last year, President Biden directed that they've got to divest the ownership and remove all the equipment and improvements that were added to the property.
So the key thing to remember from a title perspective is if you're dealing with a property that falls inside the territory that CFIUS can do a review on, make sure you talk to your underwriter before you close and have any required exception included in your policies.
That's a great point, although an exception may not be enough. One of the things that we're seeing is that compliance with CFIUS and with the local state foreign prohibition, the requirement that you've complied with it is making its way into closing instructions. So lender closing instructions will put the onus, at least ostensibly, on the settlement agent that CFIUS is complied with. Be careful. We've always talked about being careful and not taking on additional liability through lender closing instructions, purchaser closing instructions, things that you're not comfortable with. And this is one area where we've got to be careful. And the instructions are not real detailed. I've seen instructions that say compliance has been confirmed, right? That's easily missed. Jeremy, you look like you wanted to say something.
Two quick questions. So one for the newer agents in this space, what happens if you do close a transaction on a property that's, off limits? And then also, after you answer, if you could drop in the citation for the CFIUS in the chat box.
You want me to talk and drop in a citation at the same time? Okay, I can try and do that.
You drop in, Len, and I'll talk for a moment.
Yeah, go ahead.
If you close the transaction and there's nothing in your closing instructions imposing liability on you, it's not a void transaction. It's a transaction where after CFIUS review, the buyer can be required to divest. So you can close it with relatively small risk. Nonetheless, all of our underwriters will, I think, want to be careful with transactions in those areas to make sure that it's clear that we are not providing any coverage. We probably are not under the terms of exclusion 1, but better to be safe than sorry. Check with your underwriter to make sure that if you need to include an exception, you do so. If there is something in your closing instructions, remember that closing liability is on the closing office, not on the underwriter. So be very careful with those instructions and know that if your lender tells you to verify compliance with CFIUS requirements, that you probably don't want to have that included because it's really hard to confirm compliance.
That's right. And this has been one of the challenges, and we should address the state laws too. And of course, you know, any of the lawyers, they're all scratching their head and wondering, well, doesn't the supremacy clause apply here? Shouldn't this be a federal issue as to foreign prohibitions? But at least for right now, there are many, many states that have acted and have their own state foreign ownership prohibitions. And for this legislative session, First Americans Advocacy Group, I just checked with them. We've tracked 154 bills for this year. So this is still very much a hot topic. Out of those 154, 5 new bills have been enacted, 108 are still pending, and 41 of them are dead.
Yeah. Now, those state laws, you need to understand, fall in a couple of categories. Some of them have been around for a long time, have been tried, have been enforced at the state level for a long time. Others have been passed in the last couple of years, and many of those are currently facing challenges. In fact, both the Florida statute and the Arkansas statute are currently subject to court orders prohibiting their enforcement while the challenges proceed through the courts. Having reviewed all of those statutes that have passed and are now in effect at the state level, the qualifiers or the requirements of those statutes fall into these 4 categories, where there may be an absolute restriction on foreign ownership of any real estate in the land. Now, sometimes it's
commercial transactions.
Yep. Sometimes it is straight ownership of the real estate by a foreign national. Other times it is an entity that is controlled by one or more foreign nationals. Other times it is based on control of the owning entity by a foreign government. So there's variations even within that kind of absolute restriction.
I'd like to comment on that. That's one of the challenges we have with some of these prohibitions. Some of them at least give you a specific list you can look to, right? Like that CFIUS list I just dropped into the chat. You know, the U.S. Secretary of Commerce, and they do identify foreign adversaries, and there is a foreign adversaries list. So if your local prohibition refers to that section, and I'll drop that in the chat too for the local folks, you know, there is a place you can go. But we've seen references to federal lists that are classified or don't know, you know, who's on the list. You can't access it. They've described actually in legislation the OFAC sanctioned country list. Well, we all know OFAC has sanctioned individuals, but there actually is no sanctioned country list. These are some of the challenges that we have. You know, and then we have the challenges in the real estate industry, and as title agents, you've got federal laws that are supposed to prohibit us from asking things like national origin and you know, residential transactions. So this becomes very, very challenging, and it's super important. And ALTA and our local land title associations and our different advocacy groups, we tried very hard to make sure that it's not the title and settlement agents that have policing responsibility for any of this.
Yeah. The other types of state restrictions are based on the type or classification of real estate. Those that are based on location tend to be related to some type of either infrastructure, think dams or airports, or on proximity to some type of a military base within the state. And then last but not least are those restrictions based on the specific nationality or origin of the foreign owner. And again, that may be an individual or it may be somebody who controls an entity. So
Yeah.
you are going to be looking into membership of your entities if you're dealing with these laws.
When you think in terms of commercial real estate, there's lots of gotchas with this. Even if you want to start thinking in terms of, oh, this is residential, well, maybe it's an agricultural property that's part of the restriction, and agricultural property is not defined. And so is a residence that has you know, a chicken coop or a garden in the backyard, is that part of the agricultural property? And vice versa, the vacant land that is going to be intended for, you know, building of a residence or 1 to 4 apartment, is that commercial or is it residential? You know, these legislations, they don't necessarily line up with what we have. So
Right.
you're
I think
absolutely right. The title policy exclusions to government powers, police powers, perhaps specific exceptions based on conversations with your underwriter and your specific transaction and the legislation you have. But you know, none of us are knowingly participating in transactions that violate the law. So it's just another example of the complication that we have, and they're lucky that we're the ones providing the services.
Let's move on and start talking about some of these unique structures that we're seeing in terms of, we called it lending scenarios, but it's really financing structures.
100%. And here's an example of one of the things we're seeing is a more and more complicated capital stack. And for people that are interested in learning, the capital stack is just talking about the pool of money and where it's coming from to make a given real estate asset work. Whether you knew it or not, just being in title industry, you've been dealing with the capital stacks. And the most simple capital stack is going to be the senior mortgage debt. Of course, that could be a deeded trust, but it's the secured debt. They're in first priority position. And we're used to insuring that debt with a loan policy all day long. And there's plenty of commercial transactions where you only have that secured debt, and then you have the common equity, the borrower, which is getting an owner's policy. But if you look at this particular capital stack, and the more astute folks are going to notice right away and comment that it adds up to more than 100. I didn't make that chart. I noticed it was more than 100 too. So maybe it needs to be adjusted to get this thing to 100, or maybe they're trying to make some other point. But again, senior mortgage debt, it's the safest from a priority standpoint. They're in first position that they're going to get paid. So there's decent interest rates involved, mostly commercial banks and lenders involved in that section of the capital stack. You may have the junior mortgage debt or second deed of trust. Those were very popular in the early 2000s. They kind of came out of popularity. It'll be interesting to see if it comes back with the second mortgages within the commercial space. Nancy, I think you were mentioning you're actually seeing the opposite, where they're prohibiting any additional encumbrances on the property.
I am in many cases, but there is one place where you're still going to see that junior mortgage debt, and that's in the affordable housing space.
Absolutely.
Because there are a lot of municipalities or housing authorities that are trying to make sure that the properties stay affordable, and so they're doing deferred repayment deals.
Yep, you're looking at different, I think we're going to talk about public-private partnerships, and the ship and the sail opportunities that are part of that would be reflected within title policies with junior second loans, third loans, fourth loans. You're absolutely right. You've then got above, in the next pack above that, the mezzanine financing. And it's interesting because once was given a presentation, and the underwriter next to me said, "Oh, I always thought of mezzanine as, you know, the mezzanine level in a hotel." So the irony is, that's right. You don't have to be apologetic about it. That's a good way to think about it. It comes from the Italian word mezzanino, and it just means in the middle. And the mezzanine financing is in the middle between the secured debt that we're doing with loan policies and the equity. But what not everybody might know is that there is a title policy. It's a UCC Article 9 policy. It is a title policy that ensures the mezzanine financing or the preferred equity components of these capital stacks. And in fact, we are seeing the UCC policies exploding. The demand is increasing significantly, and there's a lot of good reasons for that. One is the loan to value. The secured lenders have certain loan to values, and yet the valuations on the property and the way things are, it may not work out, or the borrower, the common equity owner, may want to maximize their leverage. It's a good balance in all of these real estate assets over what's the maximum amount of leverage I can have to have the highest return possible versus over leveraging and having the project fail. So
the other coverage request you might get when there's mezzanine financing is a request for the Alta 16 mezzanine financing endorsement. That is issued only on an owner's policy because it's essentially assigning a portion of the coverage to the mezzanine financing lender in the event of a loss. They have the right to step in to the ownership entity of the entity if they foreclose out their mezzanine financing.
That's exactly right. So the mezzanine, whether it is debt-like equity or if it's equity-like in the case of the preferred equity, we often are providing owner's policies. We're providing the pledge or mezzanine endorsements where they're available in different jurisdictions. And then, of course, the common equity is getting the owner's policies. So more complicated capital stacks. We're seeing that not just because the secured lenders are saying, wait a minute, I might have more influence and control over the borrower if there's a mezzanine component or a preferred equity component, but also to get the loan to values and to get these things work. We've got so many commercial transactions that are coming due, depending on who you look at. And again, you can just go out and Google where we are within the CRE loan world. But there's estimated to be $1 trillion with a T, not a B, $1 trillion in commercial real estate loans coming due in the next couple of years. And some people are calculating this out at 1.8 trillion by 2028, which is only 3 years from now. So with all of these loans coming due, many of which already came due, and we had the extended pretend modifications or the delay and pray modifications where they weren't really getting into these things. Now's the time where you're dealing with, okay, what's the valuation? Do we have visibility and certainty on pricing? There's fewer bridge options, and the interest rates are higher. The new loans at all of these different levels are going to cost more today than they did at the time of the original mortgages.
Len, we're going to have to keep moving forward because we're going to run long today if we keep going at this rate.
We are. I was just going to say that as well. And I'm going to do the poll question now, our first poll question, because it's appropriate for this slide. And I was just trying to balance it out through the presentation. So just a quick poll question now.
And for anybody that's seeing this, you've actually got to manipulate your cursors and make a selection in order to get the poll.
So we'll take a few moments here. You know, which lending scenarios are you seeing? Are you handling senior mortgage debt number one? Seems like we're going from the bottom up. You know, second's junior mortgage debt. Interestingly, third's common equity, fourth mezzanine, and last is preferred equity. I'll show those results real quick.
Wow, we've got 27% are dealing with mezzanine financing, and 11% have done preferred equity transactions. That's great.
Yeah, it is.
All right,
What
thank
we're
you.
seeing as far as trends, and you can go on to the next slide while I just finish up. You know, you've got the collateralized loan obligation lenders. They've got new programs with loan to own where they might take on more risk because they don't mind owning the properties. We've got new mezz lenders, private equity that's coming in, and they're really touting not just their finances, but their ability to operate the property. So if it's a hotel, for example, they are known in that industry of being a good hotel and resort operators. It's all trends worth being aware of.
Yeah, we're going to take a quick peek at a couple of structures for some of the I'm not going to call them out there, but less familiar financing structures that you'll run into. The first one is a new market tax credit transaction, and you'll see that there's lots of pieces coming into this. The white box down in the kind of the center of the page, or the orange box, I'm sorry, in the center of the page, that's our borrower. And above that, everything in yellow and then over to the right side in the green and blue, that's how the money is coming in to lend to the borrower. So the lenders buy tax credits and put the money into the project via debt. Down below that orange box, what you see in green and blue and white is how the equity all comes into the transaction from various entities. And so these can be very complex. The good news about them is once you recognize that the new market tax credit piece of it all comes down to a single lender most of the time, not always, but most of the time, it starts looking a little more like a traditional transaction where you've got one senior loan and then you've got maybe a more complex equity structure inside your borrowing entity.
I love that point, especially for folks that are coming into commercial. They see an organizational chart like this, and at first it can be incredibly intimidating. It's not that your underwriters are smarter or that you're not smart enough. It's just the repetitions. We have repetitions and experience with these kinds of projects, so we can zero in on what matters. And it's really a wonderful opportunity when we can help you feel good about your transaction. And sometimes something like this that looks incredibly complicated can actually be exactly what we're looking for in your given transaction.
Yeah, and I love it when my customers give me the organizational diagram like this because it helps me put the pieces together. And if you are working on a deal that seems complicated to you or you don't really understand it, ask for this. If it helps you, fantastic all by itself. If not, it'll help us work with you. Let's go on to the next slide. This is another type of transaction, and these are public-private development. And this particular one is a combination of affordable housing and a new shelter that needed to be built. But I've also paid attention, and we've seen similar structures being used for airport redevelopment in a few places. There's some talk about doing it for ports in some communities where straight government dollars probably don't justify the kind of upkeep costs and the kind of development costs that would need to go into making it a truly viable project. But there are distinct public benefits always. So in this particular case, you'll see up at the top, we have one entity who's kind of running both sides of this. They're working on one side with the city in order to provide a city-sponsored project, the shelter, and then the city will end up being the fee owner of that portion of the property, but they have a ground lease to an operator that is then going to be the developer, and they will have a separate contract with the company that will handle the operation of that public project. On the other side of this, you have an affordable housing project with low-income housing tax credits So you have a limited partnership and again, a property manager for that partnership down at the bottom. And if you want to go to the next slide for us, Jeremy, the financing structure on this same deal was a little more complicated. This is the exact same deal, but you'll see that we have funds coming in from multiple places, 2 different entities to get either loaned to or invested in the different entities that are doing this. So again, get the diagrams. They're going to help you understand your deal better, and it helps even figuring out who you're going to be issuing policies for and what you need to be looking out for in terms of some of those kinds of issues like non-imputation coverage that might be asked about, or times when you're ending up with some overlap between lenders and owners and investors, and how does that all play out inside the policies and the transactions.
So, sorry, quick question for someone who doesn't really understand commercial transactions. That was interesting. So, Nancy, you're issuing policies for everyone who's providing money, not just the main entity.
Sometimes, yes. It depends a little bit, right? In this case, the city of St. Paul had a policy for its fee interest. The development entity on the public project had a leasehold policy for its interest. On the residential side, the limited partnership had a policy for its leasehold interest. And then we had financing going in place on both sides. So we had loan policies for the different lenders who were coming in on each side. And we had a capital stack that, well, Len wouldn't let me show you that one. So.
But it's a great question, Jeremy. And as you can kind of get the sense, commercial transactions like these, there's heavy underwriting and lift that has to occur. But in a way, absolutely, it's worth it because of the multiple policies. We call it the gift that keeps on giving.
Yeah, sometimes it's totally worth it. But in this case, we had, I think it was 12 policies altogether between the 2 sides of this deal. So you've got a fee, you've got 2 leasehold, then you've got 2 lenders on the shelter side because there was some public financing that was meant to keep it affordable. And then there was bond financing on that side. And then on the residential side, you had your primary lender, you had your tax credit investor who doesn't get a separate policy. They're part of that owner's policy, but they have special coverage requirements. And then we had the stack of deferred loans and low interest rate loans that came from a variety of providers in order to make the numbers work on that side and keep it affordable.
Let's go on to the next slide.
Actually, you can go ahead to that one. That's the one, yes. Len, we talked about mezzanine foreclosures or mezzanine financing earlier, but you've started to see foreclosures there. And what are you running into?
So there's a couple things, Jeremy. It's the previous slide to this one. There's really 4 types of UCC foreclosures, and recognize when we talked about the capital stack and our UCC policies, the UCC policies are insuring personal property, not the real estate. And so there is special opportunities for foreclosure by the UCC code that's completely different. There's private sales, which are fairly rare because a private sale has to be sold to a third party that's not in common with the lender and the party that's foreclosing. There's judicial foreclosures, also somewhat rare because if you're going to do a judicial foreclosure, the time and all of the different things that occur makes it more similar to a formal foreclosure. There's this is interesting. If any of you are told, oh yes, there was a foreclosure of UCC mezz lender, it was a strict foreclosure. I've actually asked a bunch of UCC experts, why are you calling this a strict foreclosure when in fact it's an assignment in lieu of the foreclosure? It's similar to the deed in lieu transactions that we're familiar on the land side. I haven't heard why. My biggest guess is because the strict foreclosure requires sign off and agreement by everybody. So maybe that's where they came up with that term. But the strict foreclosure is the assignment in lieu of foreclosure. It's not a UCC foreclosure at all. And then there's the public sales, which are probably the most difficult to underwrite. Remember, when you are having a UCC foreclosure, it's not typical that they're asking for another UCC policy. They are looking to the land title folks, to us. They want to either sell the real estate and there's a conveyance, or they're getting a new mortgage involved. So absolutely, you've got to be aware of this, even if you're not on the UCC side. And how would you spot a foreclosure in these things? Well, looking at those flow charts, the operating structures, you've got to ask for the operating agreements. You've got to ask for the purchase and sale agreements. Use Google. It's your friend. Particularly any mezz foreclosure that's over 50 million, it's going to show up in the real deal, and you're gonna see it right away. But reviewing your organizational documents, particularly identifying if there's a change, and verifying those changes. They'll tell you sometimes, yes, there was a foreclosure. And again, when you find that that's the case, get your underwriter involved early. There's heavy underwriting involved in analyzing this. The commercial participants still don't fully appreciate the service and the underwriting that we do. It's not just, was the foreclosure itself commercially reasonable, which is all about, did it maximize the value, and there's risk there. But you're even analyzing the pre-foreclosure documentation. Was the pledge or the mezz lender properly perfected in the first place?
And Len, the other thing that you can look at just to really make it a bright line, something's happened here, is when you look at the originally signed documents. So maybe it's your mortgage that on the fee title, pull that out, look at it, look if your signature block is different from what they're proposing for the signature block on the new documents. It'll leap out at you that there's something that has happened that's different.
And we've had that experience. I had a transaction presented me as just an extension of maturity, and we went and looked at that signature block just like you said, and we said, wait a minute, it's not the same borrower. What happened? Oh, well, there was a mezz foreclosure. Okay, well, now we've got to analyze this differently. Let's go on to the next.
All right, Len, we're going to go brief on EB5.
Yep. So EB5 is similar in the different kinds of capital stacks. EB5 is still out there. You'll see a little bit of the flow chart similar to some of the stuff that Nancy showed you. On the one hand, there's flow of funds. The thing about EB5 is that it's kind of the chicken and the egg. The EB5 providers in the regional center need to have a certain structure in place that's going to then be presented to all of the investors in order to fund. But who's really setting this up without having the funding in place? And so for all those reasons, an EB5 transaction is a high risk underwriting transaction. You really need to make sure that there are other funding sources and senior lenders involved, and speak with your underwriters about it. Next slide.
Yeah, President Trump has made some comments about EB5, and he's now talking about this golden visa. How do you think that's going to play into what we do?
So it's interesting, and we'll talk when we get to the economy and what we predict or see later on with all the different changes that are occurring. But Trump did make a comment about that he wasn't happy with the EB5 programs. Of course, these are government programs that provide visas, green cards to investors when they invest a certain business investment. And he's saying, why not just have a $5 million golden visa? So the EB5 programs are still going. I'm involved with a half dozen of them. What was interesting is I reached out and wanted to know, does the announcement about the golden visa and these comments, how's this affecting current EB5 transactions? And I was kind of surprised, pleased to find out that they're oversubscribed. The existing programs, maybe foreigners are looking to jump in right now before the price goes up. So it's a counterintuitive effect of what's happening. But the existing EB5 funding, certain transactions are oversubscribed, and they're really interested in getting these things done still.
That brings us to CPACE financing. This is a type of financing that comes in and is repaid through property tax assessments, right?
That's right. CPACE is authorized. It has to be authorized by, the state and local legislation. There's no federal CPACE program. CPACE just simply stands for commercial property assessed clean energy. There's also an RPACE for residential, but it's only in 3 states, California, Missouri, and Florida. The key characteristics of CPACE, the reason that it's interesting in the capital stacks and it's exploding, and we'll show you the next slide that this is the case, but the loan terms of a CPACE finance is typically substantially longer. Entities and commercial loans, they're not like mortgages to individuals. Nobody's getting 30-year loans to an entity. The business loans are, a long-term loan is 7 to 10 years. CPACE allows for a term that can be, 25, 30 years. And by extending out that term, it can help with the loan to value and the interest rate coverage ratios and make deals work. It also is designed for resiliency. And I'm not just talking about, green improvements. We're really aware from the wildfires out in California, from the hurricanes down by me, I'm talking to you from Miami, the resiliency of commercial property is extremely desirable and needed, and may also help solve one of the big challenges in commercial real estate right now, which is the property casualty insurance. How is the cost of the property casualty insurance against these natural hazards, which seem to be occurring more and more? So when you see CPACE involved, and we've have active transactions where CPACE is used as a pseudo construction loan. Show us the next slide. You guys can see for yourselves how much CPACE is exploding. So CPACE is a reasonably new development in real estate. From 2009 until like 2020, it took until you had 2 billion worth of new CPACE loans. But just since then, look at the parabolic rise, the explosion that has occurred. And I don't have, the 2024 numbers showing approaching $10 billion in CPACE financing for this past year. It's incredible.
Yeah, typically the CPACE lenders are not recording mortgages and not asking for title policies, but you'll run into them on a regular basis as a part of your capital stack. And you may find some requests for insurance. There's certainly options and ways to do that. It may be best through a UCC policy, but that's something to investigate as it comes up on your transactions.
Yeah, great point. What's FinCEN's final rule, and is it different from the CTA? Well, the Corporate Transparency Act at this point, hopefully everybody knows that's on hold. And yes, it was very different. FinCEN's beneficial rule for real estate, which has to do with settlement agents having the responsibility of reporting the beneficial ownership on cash transactions. There was some confusion when there were so many different rules that kind of overlapped and were asking for seemingly the same beneficial ownership information at the corporate level, at the transaction level, with the rule, and then the geographic targeting orders, which, by the way, are still in effect in the areas that they're in. Again, Nancy and I wanted to point out that you might, if you're only in the commercial world, think, oh, that new rule, it's really a residential transaction or shops issue, and that's not at all the case. There's the vacant land, and the vacant land that's intended for homes, for 1 to 4 apartments. All of that is very much commercial and will be subject to the rule unless the rule changes between now and December 1st. Jeremy mentioned the effective date is December.
The other place you might run into it is in a mixed-use development where you've got residential on the ground floor and, or I'm sorry, residential above commercial space on the ground floor. So be careful with it. And it's not just cash transactions, it's also private lender finance transactions. So this is going to be broader. The
Absolutely.
default reporting person on this is going to be whoever does the closing and records the documents. And it's going to require that you dig in to information about the entity that is acquiring title. And it also applies where a trust is buying the land. So it's not just entities, it's entities and trusts.
Yep.
You're going to have to dig down to who the actual beneficial owners are, and we're going to have to be filing those reports within a certain number of days. So make sure that if you are dealing with any transaction that might come close to this, you understand what your reporting obligation would be. The reporting obligation can move on to somebody else, but if you are closing the transaction, make sure you have it in writing who's doing it and in an agreement form so that you're covered.
Again, look at your closing instructions, right? That could be buried in the closing instructions that you're going to file.
Absolutely. And since the CTA is not currently being enforced, always subject to change, FinCEN's going to be leaning heavier on our industry for this. And they're doing that because we did so well with the GTOs that they think it will help them recapture even more money laundering.
And that's, again, an ironic thing for our industry that's under attack by, you know, the government saying, oh, let's do pilot programs, let's save the costs of closing and title insurance because it's too high. And yet, who are they leaning on for some of the most important aspects of compliance and protection? So let's go to the next slide.
Which is fraud.
That's a good one.
It is. I think we're not going to spend a lot of time on specifics of specific incidents that have happened, but let's go ahead and move on to the next slide because this really shows you what the issues are. Fraud related to real estate is huge. And while some of those numbers were going down in 2023, you'll notice that others were going up. That's in part because they started to recognize that things like real estate fraud needed to be categorized correctly. And so they have changed things, reclassified some of those to business email compromise. They have reclassified some under the identity theft. And earlier this year, I had a sneak peek at another presentation into what the 2024 numbers look like. And again, they have come out with another classification. They are separately tracking now what we call seller identity theft, but they are tracking it and calling it deed theft, which isn't really accurate, but that's being tracked separately. So again, our real estate numbers are down, our wire fraud numbers are down, but overall fraud continues to be a big issue.
That's a huge point, and it goes to wire fraud is now more likely to be captured within business email compromise. That's the #1 way that wire fraud is being perpetrated. The real estate theft is now the vacant and unencumbered lands being the deed theft. And I know, again, this has been a theme throughout the whole thing. Commercial practitioners might think, oh, the fraud is more on the residential side. Well, no, the vacant land that's going to be developed is often vacant and unencumbered, and that's the #1 risk. And in fact, we are seeing fraud industry-wide as becoming one of the #1 issues for commercial transactions. We've spoken about the wire fraud, and if you show us the next slide, there's good news. You guys have probably heard about the RAT team, the recovery asset team. You guys have heard about the fraud kill switch and the effectiveness of if you call for not just a regular wire recall, you must call for the fraud recall, which is different. And you might have to give an indemnity and say, yes, it's really fraud before anybody else can really look into this in order to make it effective. And that's important to distinguish. But it's been very successful. 71% in 2023 was returned, frozen, and eventually returned. And I don't know, Nancy, if you saw the sneak preview for this, but I would guess 2024 that 71% success rate has either stayed consistent or gone up.
Yeah, I didn't get to see those numbers, but I think you're probably right on that. Most of these numbers are talking about technology-related fraud in some way.
Yep.
We can't lose sight of all the other types of fraud either. So you still have to be alert to and aware of and watching for impersonations. You need to be looking for forgeries. All of those things are important to be alert to as you're receiving documents.
So now we got our next poll question.
We're getting close to the top of the hour. We're probably going to go over a little bit, so stick with us. Quick poll question again, just to get a sense of how many transactions in the commercial space you're handling.
These are good questions.
Well, it looks like 40% handling 1 to 4, roughly 30%. I'm going to close this, so if you want to get your answer in, now's the time. Closing it, sharing it. So majority 1 to 4, followed by more than 10. Actually, that's kind of surprising. So.
Yep, we have a sophisticated audience on our hands.
We do.
We do.
Yes, we do. All
What's
right.
the next slide?
That brings us to a point where we're talking about the economy, and our bonus question is, so what's going on with the economy? So I think we should just kind of combine these together, Len.
Absolutely.
Let's start talking about what we're seeing with distressed property transactions.
Well, both of us discussed that we are seeing a giant increase. Commercial transactions started to increase about 30% in the fourth quarter of last year. First quarter this year, just in the books, it's only April 9th, and yet as busy as could be. It's that, 1.8 trillion of existing loans that are coming due. It's a little bit better pricing and visibility. It's all of those kinds of things that are leading to us having confidence that commercial transactions are going to stay strong and accelerate as we go through this year. We've got some air pockets, obviously, with the tariffs and the market concerns about how that works. But there could be surprising results from all those types of things. We're very interest rate dependent, and the Fed is still signaling 2 interest rate cuts this year, preferably, presumably 25 basis points. After the tariffs, which are recent announcements and caught a lot of people by surprise on the depth of and scope of them, the Chicago Mercantile Exchange has a Fed watch, which I pay attention to, and it actually increased the likelihood that the Fed will cut interest rates. Went from 44% believing no cut to 55% expecting a cut. So interesting.
Yeah, I've seen a lot of increase too, although, it's been less the traditional foreclosures and far more deeds in lieu or receiver sales, that sort of thing, which all have their own complexities. So you do need to be careful when you're looking through them and work closely and look for guidance on specific requirements related to those.
Yep. So any one of these transactions, any one of these topics, we could have spent just the whole hour just on those. This was a, top 5 topics to put in front of you. We hope we hit the mark on saying some things that were interesting and impactful to you. Doesn't look like we got to the Q&A, Jeremy, but like I said, if anybody writes to you in the chat or by email, and here is Nancy and my email contact information if anybody wants to contact us directly. Again, we love what we do, and it's a gift to us to do it. So please, our doors are open.
Yeah, you guys are definitely passionate about it. Amazing that you did the top 10 at Alta One last year in an hour. So we boiled this down to 5, and yes, you guys could have probably taken 1 and it got in deeper. But based on the survey results, very sophisticated audience, maybe we consider that for future webinars. If there's a specific topic in the commercial space you're interested in, let me know. We also hold the commercial network event that digs into more about topics affecting CRE. Nancy and Len, thank you. I learned some things as we talked in our pre-call. This was definitely educational for me. Hopefully everyone on the call learned something. As a reminder, I have got a few questions. If you missed parts of today's webinar, or if others in your office would benefit from listening, you'll get a recording to the presentation in an email tomorrow. You also get a link to the CE/CLE info if you didn't get it in the chat box. The email will also include a link to get a copy of today's presentation. So tomorrow's email will have links to everything you need. Let's see. If you have a question about education credit, email education@alta.org. I do need to thank SoftPro once again for sponsoring today's webinar. And quick question about the GTOs. Yes, the GTOs will remain in effect until the AML rule goes into effect, and that will replace the GTOs. Pending what happens.
More accurate answer is the GTOs have specific dates involved. I believe that one is expiring soon, in like April 14th or so, but we expect it to be renewed with new dates. So that's how you get to the broader.
Correct. Yeah, it expires next week. Yeah, they pretty much been extending them continuously. So, all right, well, that brings us to the conclusion of today's presentation. Take care, everyone.
Thank you. Bye-bye.
Thanks, everyone.
Thanks, Nancy.